Hello. In this discussion, we'll consider personal activity deductions. Respectively, remember that with respect to deductions, there's three categories. The categories are business, investment, and personal in nature. Now, remember that if you are a taxpayer, you prefer to be classified as business over investment over personal because there's less limitations with respect to what you can actually deduct, both in the amount and actually getting a deduction. Next is investment. And then finally is personal. Now, business and investment considered together are known as gain seeking or profit seeking. Section 162 dealt with business activities. And in order to have a business activity, there were 7 criteria that must be met. The outflow must be ordinary, necessary, an expense, paid or incurred during the taxable year, in carrying on, a trade or business, and there must be substantiation. If you meet all 7 of those criteria, you have a general business deduction, which again has the most ability with respect to being able to be taken, as well as the least amount of limitations. So that's very good. If you meet criteria 1 through 5 and number 7, so you meet the ordinary, necessary, expense, paid or incurred during the taxable year, and carrying on, and the substantiation, then, but you fail the trade or business, you might be able to get Section 212 dealing with investment activities, which dealt specifically with the production and collection of income and tax matters. Now, if you are not considered gain seeking, then and you don't meet Section 162 or 212, then all that's left is personal. And the general rule, so the general rule for personal, and this is why it's the least favored of the 3 categories, the general rule for personal deductions is that they're not allowed to be deducted. Under Section 262, personal deductions are not allowed. They're disallowed. They're not allowed as deductions. Unless, there's an exception, unless the code provides otherwise. Unless otherwise specified. So what are some examples of when the code specifies this? These include mortgage interest, the mortgage interest deduction on a personal home. This is a perfect example of one that's allowed even though it's your own personal house. Another example includes charitable contributions to qualified organizations. With certain limitations, these are allowed. Now, one thing I want to discuss is, let's say you have some type of activity that you think might be business or investment, but it actually is not because it's not for profit. I'm sorry, it's not a not for profit. It does not meet the criteria of, it's not the phrase for profit. It does not meet that. Okay? So it's not profit seeking. Now, how do we know that? Section 183, which deals with hobby losses, has special rules of what's considered profit. Of what is a profit. It's in the regulations. So when is profit met? Because if activity is considered profit, then it's either business or investment. It has to be, because remember, gain seeking deals with profit, the profit nature. So the general rule for Section 183 hobby, which we call hobby activities, which hobby activities are personal. They are activities that do not meet the criteria of business or investment, and there are certain outflows involved. To be a hobby activity, it fails the profit test. So the regulations specify various rules for whether a profit is met or not, but one of the things is there must be a profit for 3 of 5 years, considering 5-year period, or 2 of 7 if you're looking at the horse business, horses, special carve out for lobbying of horses there. So 3 of the past 5 years, including the year at issue. It doesn't have to be 3 consecutive years, just 3 of 5 years. Did you have a actual net profit? Did you actually net a positive profit amount? That's a bright line rule, but there's other ways to prove a profit. how does this work? Before we go into the specifics, I want to make note that the Tax Cuts and Jobs Act of 2017 made a big difference with respect to the taxation of hobby losses with respect to tax benefits. And really what it did is the Tax Cuts and Jobs Act of 2017, 2018 going forward, a lot of the miscellaneous itemized deductions that were allowed to be taken prior to 2018 were actually eliminated, and one of them was actually the hobby loss deduction rules, which you're going to learn. You're going to be able to deduct up to the amount of hobby income and other items as well if you look at the different categories 1, 2, and 3. But really the rule is 2017 and before that you can take hobby loss deductions up until the amount of income, but 2018 and after you can't take any hobby loss deductions. So you're saying, well, why are you learning about the specifics of hobby losses 2017 and before? Well, really two main reasons. First, it helps distinguish from gain-seeking activities, business and investment, which is very important because if you are viewed as hobby loss, then you're not going to be able to get those deductions. The second is that the law could change. Just like the law was at a certain point, it could change again. So now we're going to talk about the specifics of hobby loss and what the rules were 2017 and before, just so you understand what's going on, and then we'll come back and we'll recap those things. If you are considered a hobby, you can take deductions up to the amount of income. This is important. You can take deductions up to the amount of income, but you can't go above that. So you basically cannot have a negative amount. So deductions up to the amount of income. So let's say that I have a coin collection and I actually sell some coins. And when I first started, I was selling coins, but I actually put more costs into it because it's a hobby in the general sense we think of hobby. But let's say maybe, maybe 7 years into it, I'm actually making money because I'm making so much money from this coin collection. Well, if I want to actually be able to deduct more than the amount of the income that I get off the coin collection activity, then I have to show that it's considered profit, and then it'll be, if it's profit, it's considered business or investment. But if it's not considered profit, guess what? It's going to be personal. It's limited to, my deductions are limited to the amount of income. So that's really key. Now, one thing to note also is that for personal activities, almost all personal activities are below the line deductions. Below the line deductions. And that's very important because, again, in our general introduction to deductions, we talk about how above the line deductions are much better because of that standard deduction issue. Because the personal hobby activity issue only comes up for individuals. If you're an actual business, you're going to be in the business or you're going to be in investment seeking, because the idea is that you actually are looking for a profit. Just a reminder, that's the tax consequences for tax years 2017 or before. 2018 or after, you can't take any hobby loss deductions at all under the Tax Cuts and Jobs Act of 2017. Very important. But again, it's very important to understand this because it does make a distinction whether it is a hobby activity versus an investment activity versus a business, because hobby is non-gain seeking, which means it's personal, versus investment in business. If you are not considered a hobby, and then you are considered potentially an investment activity, which you're not limited under the Tax Cuts and Jobs Act. So it makes a big difference with respect to those items. So again, the rules we're talking about, the application is for 2017 or before. So let's continue. Now, considering the Section 183 hobby activities even further, there's actually 3 different categories with respect to hobby activities. So let me create a little thing here. So within hobby, let's say we have hobby loss, as we call them, or deductions. There's actually 3 types. The first type are deductions that would be deductible already for personal activities. These include the mortgage interest, the charitable contribution, those kind of things. Other types of interest, paying taxes. These are already part of that. So they're already deductible for people. You don't have to be in an actual hobby activity. Already deductible. So that's category 1. And these can be taken beyond income. So the general rule that you can only take deductions up to the amount of income, that holds true. But we have to put them into categories of what type of hobby loss it is. So category 1 is already deductible, so those can actually go beyond income. So category 2 deals with the general rule, which is right here, which makes up almost all the hobby losses. So again, the general rule is that you can take deductions up to the amount of income, but nothing more than that. Just a reminder, that's the tax consequences for tax years 2017 or before. 2018 or after, you can't take any hobby loss deductions at all under the Tax Cuts and Jobs Act of 2017. Very important. But again, it's very important to understand this because it does make a distinction whether it is a hobby activity versus an investment activity versus a business, because hobby is non-gain seeking, which means it's personal, versus investment in business. If you are not considered a hobby, and then you are considered potentially an investment activity, which you're not limited under the Tax Cuts and Jobs Act. So it makes a big difference with respect to those items. So again, the rules we're talking about, the application is for 2017 or before. So let's continue. So category 1, you can go beyond the income because those are already allowed in the Internal Revenue Code. Category 2 is the general rule, which is all others other than category 1. Category 3 are hobby losses or deductions related to that affect basis. That affect basis, which we'll talk about later on, or in another, you'll see in another topic, affect basis. And items that affect basis are deductible only to the extent that the taxpayer's gross income exceeds the type 1 and type 2 activities. Just a reminder, that's the tax consequences for tax years 2017 or before. 2018 or after, you can't take any hobby loss deductions at all under the Tax Cuts and Jobs Act of 2017. Very important. But again, it's very important to understand this because it does make a distinction whether it is a hobby activity versus an investment activity versus a business, because hobby is non-gain seeking, which means it's personal, versus investment in business. If you are not considered a hobby, and then you are considered potentially an investment activity, which you're not limited under the Tax Cuts and Jobs Act. So it makes a big difference with respect to those items. So again, the rules we're talking about, the application is for 2017 or before. So let's continue. So basically, this is all about doing it in order. It's all in ordering. You first look at category 1 activities. You take those first. Category 2 is next. And category 2, you take only to the extent of hobby income. But if there's already too much with respect to category 1, you don't take any. And then finally, category 3 are items that affect basis, like depreciation on property or amortization for intangibles. You only get to do category 1 and 2 first. So it's all about ordering. This is an ordering rule. Because the idea is you can only take so much. Now you're thinking, well, why does that make a difference? Because, you know, if you have the amount, then okay, you already have the amount. And that is key, but the reason is because it might affect your sale of certain things with respect to the basis. And with the basis item, if you get to take a deduction, it lowers that, so it's more of a timing concern. More of a timing concern. So this really concludes our personal activity discussion with respect to deductions.